Hello guys, this is Paris. Welcome to Budgetholics. Today's video is going to be about the namesake of this channel, which is budgeting. Budgeting has gotten a bad rap over the years, with the prevailing image being a miser, not enjoying life, not giving anything to anyone, and just hoarding his money aimlessly. Budgeting is just a strategy. And to paraphrase the game theory definition of a strategy, it's a complete contingent set of actions you need to take in order to reach your desired level of wealth. Budgeting is practiced by virtually every government and every company out there. However, it's only practiced by a few individuals, and those individuals are the most successful when it comes to their money. There are 5 simple steps you can take in order to create an effective budgeting strategy for yourself, and if you follow these steps, you will be on your way to reaching your desired financial position in 20, 30 or 40 years. If you're interested in personal finance, investing and wealth building, as well as budgeting, obviously, please hit the like and subscribe button. The first thing to do is create an expenses list. This means keep every receipt and write down every single cent you'll spend. Depending on what kind of person you are, you might prefer to do this on a piece of paper or on a spreadsheet. Your bank may also offer a service where it categorizes your expenses and keeps track of what you spend and where. Even if you don't do anything else on the list, just do this first step for just a month. After a month, you'll have a list of what you spend and where, and you'll be able to identify between the things you need and the things you want. A common mistake people make when it comes to personal finance is confusing their needs with their wants. You may need a computer to do your job, but you certainly want a $2,000 gaming computer to play games online. You need a car, but you want the newest BMW. You need a phone, but you want a new iPhone. A certain pattern arises where people mask their wants as needs. A certain pattern arises where people mask their wants as needs. What managers use is the 24-hour rule, which means that you wait for 24 hours for the dust to settle, you think about it for one day, and then you decide if you really need this or you just want it. After you've completed your expenses list and you've identified which of those expenses are wants and which of those are needs, you'll be able to reduce the amount of money you spend on your wants. Do you really need 5 different subscription services? Having completed this first step and having cut back on unnecessary expenses, let's move on to steps 2 and 3. Now, steps 2 and 3 are things you can do simultaneously. Starting off with step 2, you need to open a checking account. If you're already getting paid in a checking account, that's great. You might be able to skip this step. For the rest of you that are being paid in cash or via check, you need to open a checking account for 2 reasons. But for those of you who receive a large amount of cash in hand, you need to immediately deposit it in a checking account, especially when it comes to paychecks, which you can cash out at various random stores, which charge you a fee from 1 to 10%. The problem with having a lot of cash in hand is that you tend to forget that this is the maximum amount you can spend for 2 weeks or for a month. This leads people to impulsive buying. Having that large cash amount on hand will make you purchase things you don't really need, and by the next time you get paid, you will not have enough money to pay for things. This will lead you to applying for a payday loan or increasing your credit card debt. Another thing to consider here is the taxes you'll need to pay on that income. Speak to your accountant. I'm not a certified financial advisor, so speak to a certified professional near you and ask them how much money you'll need to pay in taxes by the end of the year. Save that money separately. Step number 3 is to open a savings account. In this savings account, you want to create an emergency fund as soon as possible, wherein you'll deposit 3 to 6 months of income. When it comes to an emergency fund, some people believe you should create a cushion of $1,000 to $2,000 as soon as possible and then build up to 3 to 6 months of expenses. And some people think that you should just build up to 3 to 6 months worth of expenses without immediately needing to create a cushion. The reason you will need this emergency fund is that something might come up that you hadn't planned for, and something will come up that you haven't planned for, at some point in life at least. Depositing this money in a savings account will to some degree protect your cash from inflation, although not completely. When it comes to the emergency fund, this should be as liquid as possible. You shouldn't invest this money in real estate or buy stocks or even cryptocurrencies. Not buying real estate is obvious. You might need this cash quickly, and it's not that easy to sell a house within a day or two. When it comes to investing in cryptocurrencies, sure, they're extremely liquid and you might get your money in 30 minutes. But you might also need to sell at a very bad time. Similarly, stocks are also quite liquid. Depending on your broker, when you sell off your stocks, you might receive the payment in. However, you might need to sell those stocks at a very bad time for you, thus losing a lot more money that you would have lost due to inflation. Also, you might need to pay capital gain taxes on that money, thus further reducing your initial principal amount. So most financial advisors agree that the best way to store this emergency fund is to have it in a high interest rate savings account, and you will only tap into it when an emergency comes. The new iPhone is definitely not an emergency, although I can see the appeal. After you've opened the checking account and the savings account, you now need to pay off any high interest rate debt. That means anything about 5 or 6%, such as payday loans, such as credit cards, and in some cases even student loans. You can start paying your low interest rate debt after you've created your emergency fund, but you should also pay your high interest rate debt while simultaneously building this emergency fund. Think of paying off debt as investing your money with a guaranteed return. Credit card companies, for example, charge around 20% interest rate. If you pay off your credit card debt a year earlier, you're guaranteed to make 20% on that money. There are two schools of thought when it comes to paying off debt. The first is Dave Ramsey's snowball method, and the second is the avalanche method. The snowball method involves paying off the smallest debts first. This method is all about building motivation as you start paying off your debt. The second is the avalanche method. This means that you first tackle your highest interest rate debt first, and then move on to the smaller interest rate debts. Although the avalanche method is about accounting efficiency, the snowball method incorporates some psychological variables which may best fit you. Regardless of which method you choose, focus on paying off your debt. Many people fall into the trap of believing that they can make an investment and postpone paying off high interest rate debt. Warren Buffett has an average return of 20% a year through diligent investing and research, while your credit card company has a guaranteed return of 20% a year by you not paying your debt. If you think you can beat Warren Buffett's return, by all means, don't pay off your high interest rate debt. But the sound thing to do here is to pay off your high interest rate debt and maybe go easy on your low interest rate debt while simultaneously building up an investment portfolio. Now, debt has also gotten a bad rap. There is good debt and there is bad debt. An example of good debt is house loans or getting a loan to start a business. An example of bad debt is getting a payday loan or a credit card to pay for things you really can't afford. Now that you've created an expenses list, you've opened the checking account, you've opened the savings account, and you've paid off any high interest rate debt, you're ready to start investing. When it comes to investing, there are lots of stuff you can do with your money. You can invest in real estate, stocks, bonds, cryptocurrencies, or you might just hear about a good business venture a friend might tell you about. The key thing to remember when you invest your money is remaining within your circle of competence. This is what Warren Buffett does. Only invest in things and businesses you understand. Do not get rushed by the fear of missing out on a good investment, and do not do something because everyone does so. When it comes to budgeting, there are different variables that will create the ideal allocation. It might be best that you spend 50% of your income and the other 50% you use to pay off debt, save and invest. Maybe you need to spend a higher percentage of your income. Maybe you need to spend a lower percentage of your income. And this is where lifestyle inflation takes place. Lifestyle inflation refers to a phenomenon whereby you increase your spending as your income increases. If you could survive with less, you can still do it and you can still invest. For example, if you're getting paid $50,000 a year and you only need to spend 50% of that, which is $25,000 in order to live decently, if you get a raise and you start earning $60,000 a year, there's no reason to immediately spend these extra $10,000 and not put them to work by investing, buying real estate, and what have you. Thanks for staying till the end. If you got any useful information out of today's video, please hit the like and subscribe button, and also feel free to share the video with anyone you think might need it.